watching this are really great. The reason is you're watching this video. Hope all of you are doing great. Today in this video, we will be learning about ratio analysis, which is the second chapter in the management accounting subject in final year BCom. This is a full-fledged chapter where you can expect a 2 marks, a 6 mark, and even a 14 marks question from this chapter. This chapter mainly is a practical oriented chapter, but still 20% of this chapter consists theory. Now let's see what is ratio. Ratio is nothing but a simple arithmetical expression which relates one number to one more number. Ratio analysis means using these ratios, if we can analyze one account to one more account in our management or in our accounts, then it is called as ratio analysis. In this chapter, there are 4 categories of ratios that we will be dealing in. Today in this video, I will be teaching you first 2 categories of the ratios that is very important. And the first category, under each category there are 2-3 types of ratios. Let's go in detail and learn about them. The first category is liquidity ratios. Under this liquidity ratios, the first one is current ratio, which is also called as working capital ratio. In your exam, they might ask you to solve as working ratio or current ratio, anything they might ask. Current ratio is also called as working capital ratio. This ratio expresses relationship between current assets and current liabilities. And the formula for this is current assets divided by current liabilities. And there is also a thumb rule for this ratio, and the thumb rule is 2:1. That means if the liabilities is 10,000 rupees, that means current liabilities is 10,000 rupees means then the current assets should be 20,000 rupees. Only then this, according to this analysis, this ratio analysis, the accounts are the proper analysis is correct. Otherwise, there is a little bit of difficulty. I repeat, if the liability is 20,000, the assets should be double, that is 40,000 rupees. Now let's see the second ratio. It is called as quick ratio or acid test ratio or liquid ratio. Quick ratio expresses relationship between quick assets and current liabilities. Quick assets is something that is new to you people. All these days you heard only 2 things, current assets and current liabilities. But what does quick assets mean? Quick assets means current assets minus inventory plus prepaid expenses. In other way, we take all the current assets in quick assets except inventory and prepaid expenses. And the formula formula for quick ratio is quick assets divided by current liability. And there is also a thumb rule for this ratio that the quick assets should always be equal to the current liability. Only then it proves that the business is performing well, that they have maintained well. Now, that means if quick assets is 10,000 rupees, the current liabilities should also be 10,000 rupees. Only then it means it is balanced. Now, let us see the third one. The third one is absolute liquid ratio or cash ratio. Absolute liquid ratio is also called as cash ratio because it expresses the relationship between absolute liquid assets and current liabilities. Absolute liquid assets are cash in hand, cash at bank, and marketable securities. Absolute liquid assets means any asset that can be liquidized very easily. For an example, cash in hand, it's already in a liquid form. Cash at bank in the seconds, because thanks to our digitalization of India, we have got lot of phone pay, Google Pay, and lot of net banking. Liquidating money is very easy nowadays, and this is a small formula to know the ratio, and the thumb rule for this ratio is 1:2. That means absolute liquid ratio is 1 and current liabilities is 2. That means Absolute liquid ratio should always be half of current liabilities. Hope you have understood. I know there are a lot of formulas and there are a lot of ratios that you have supposed to learn. You can remember it or by heart these things. What I suggest you is, if you start doing sums, you need not by heart. Over a period of time, immediately you will understand the relationship between each and every ratio and you will get it like that. Okay, let's see the second category. And the second category is turnover ratios. Under turnover ratios, I guess there are five subcategories of five ratios under the category of turnover ratio. The first one is stock turnover ratio or inventory turnover ratio or velocity ratio. It is a ratio which shows the speed at which the stock or inventory is converted into sales. It can be calculated by using the formula. These are the formula. Now, what is this stock ratio means? It's a very simple one. For an example, I buy ice cream. For example, I have 100 ice creams in my shop. In the month of summer, all those 100 ice creams will be sold in 1 or 2 days in summer. But when it comes to winter, the same 100 ice creams will take more than a week to be sold. To calculate this turnover ratio, we have a formula that is called as cost of goods sold by average stock or inventory, or inventory turnover ratio is equal to net sales divided by inventory, or inventory turnover ratio is equal to net sales divided by average stock or inventory. You can use this formula based on the information available in the question. Each question will give you different types of particulars. So based on the particulars that you get in each question, you can choose the appropriate formula and find out the stock turnover ratio. Then we have, okay, what is cost of goods sold? Cost of goods sold is equal to sales minus gross profit. I hope by this time all of you definitely know what is cost of goods sold. And they have also given the formula to find out the average stock. The formula to find out the average stock is very simple. Opening stock plus closing stock divided by 2. Then we have one more thing called as stock conversion period. I guess I'll come back to this later when I'm doing the sums. Now I guess it is not appropriate to teach you this. The second one is debtors turnover ratio. Debtors turnover ratio is a ratio which indicates the speed at which average debtors are turnover into the sale during the year. As all of you definitely know what are debtors, but I'll still repeat because I know when I do classes to you people, a lot of you people come to me asking what do you mean by debtors. No problem, I will explain what are debtors. For an example, I have a mobile shop and I sell a mobile to a person called as X. When I sell this mobile to a person called as X, if he pays the cash immediately for me, once he takes the mobile, then it is called as a cash sale. But if that person X tells that he will give me the money after a month or so, then I am doing this sale to him on a credit sale basis. And that person X is called as debtor. He is liable to pay money to me. Sundry debtors is equal to average debtors minus bills receivable. And the debtors turnover ratio is equal to net annual credit sales divided by average debtors. Okay, where we have one more few more formulas related to that, where net annual credit sale is equal to total sales minus cash sales minus returns inwards. Returns to inwards is nothing but it is nothing but sales returns. It means, for an example, I do a sale to somebody. When I do a sale to somebody, immediately after 5-10 minutes that he will realize that mobile is not switched on or there's some problem in that mobile phone, he will give it back to me. When he gives that mobile back to me, he not give me any money. So total sales minus cash sales minus return inwards, that is nothing but sales returns. Average debtors calculation formula is opening debtors plus closing debtors plus bills receivable divided by 2. Anyways, however, I'll be sharing all this PPT to you. There is this PowerPoint presentation later to you people so that you can clearly make notes of all this and you can revise, because all these things will definitely take time to digest in your brains. So please, let's concentrate and learn this. Then we have debtors collection period or average collection period is equal to number of working days in a year divided by debtors turnover ratio. As we discussed, doing credit sales is very easy, but collecting the money from them later, if somebody is doing business, they'll definitely come to know collection of money from debtors is like a godly task, which is very difficult. You speak to them very harshly, the customer is gone for lifetime. He might even be converted into a bad debt. You're supposed to talk to him smoothly, you're supposed to have a good relationship. At the same time, you should make sure that he gives the amount to you within time. Next, we have the third one, that is called as creditors turnover ratio. As I told you, for debtors, this is creditors. Creditors means we purchase goods from somebody on a later payment basis, and we are the creditor, and the person who gives us money, I mean goods, if we are owed to somebody, then they are creditors. For an example, I will go and buy a mobile phone from a shop, and if the shopkeeper doesn't take money from me, and I will tell him that I will give this money after 1 month, I that person is a creditor to me. I am supposed to pay money to him. And the creditor turnover ratio is equal to net annual credit purchase divided by average creditors. And to find out to average creditors, it's similar to average debtors. Opening creditors plus closing creditors plus bills payable. It is just the opposite for average debtors. And the fourth one is creditors payment period or average payment period. See, generally what happens is normally this credit system doesn't hold good on a daily basis, but when you come to industrial business, even today, the credit period is 90 days. That means you come to my shop, I prepare 10, let us call it as beds. I prepare 10 beds to you people and give it to you people. You can take 90 days time to repay me. Even now, in lot of countries, for example, factories which prepare nuts, bolts, steels, carving industry, still follows the same thing. They give 90 days credit period for you to repay the amount. Creditors payment period is equal to number of working days divided by creditors turnover ratio or average creditors divided by net credit purchase per day. I know there are a lot of doubts going on. You might have already forgotten the previous ratios. No issues. It's absolutely fine. You can watch this video not once, several times. But in the next video, when I upload more about sums, when we solve sums, slowly all these ratios will go into a head. Don't worry. We have the last one in the second category, that is called as working capital ratio. Working capital ratio is equal to cost of goods sold divided by average working capital. This is a very easy ratio. And what I can tell you people is, if a single ratio is given to you in the examination, it will come for 2 marks. If more than 3 or 4 such ratios are given to you in the examination, it will ask for 6 marks. Where multiple, that is minimum of 5 to 10 ratios along with a little bit of transactions, then you will get it for a 14 marks question. Please believe me, people, it's a very simple chapter to learn. Please do not neglect it. However, you are in home now, so learn. The third and the fourth category ratios will be uploaded in the next video. Until then, revise this video. Have a nice day. Thank you. Finally, as I tell you in every video, which I always tell you, identify yourself, build yourself, be yourself. Thank you.